Hi, I'm Alan Maciel, and this is the Live Better, Explore More podcast. We're bringing Blayney White back again to talk about banks and all that's going on with them.
Welcome to the Live Explore podcast. If you like what you hear, please hit like and subscribe.
Blayney, welcome back. The real question is my money safe?
Oh boy, Alan. Well, thank you for having me back again. And the answer is it depends where your money is.
So, give me some ideas. So, is it a small bank it's not safe, a mid-sized bank it's safe or not safe? The big banks seem to be no problem.
Well, I think it's really more a question of the balances you're carrying in your accounts, whether or not your money's safe. Because there's this little thing called FDIC. It's insurance offered by the government, and it insures up to $250,000 per account per bank. So you can only have one account that's insured. So if you had a big bank with 5 accounts and they each had over $250,000, only one of those accounts is insured to be returned to you.
Okay, so let me do the math on this one.
Okay.
I have 5 accounts, regardless of what bank, right?
Regardless.
Because the FDIC did not identify it's only for big banks.
Correct.
Right? So I have 5 accounts, $200,000 each. That's $1 million in one bank. If things go bad, I'm only going to get $250,000 back from the FDIC.
Correct.
So how do I fix that?
Well, you can have an account at different banks. So you might choose several different brands. Maybe one is like a community bank or a credit union they're referred to. Maybe one is a big box bank. You know the big box banks.
Okay.
You could have money in stocks. You could have money in treasuries, which are bonds. And all of those, if you disperse them out to not exceed $250,000, you're going to be okay. You could also put your excess cash into real estate, which is what I love to talk about, because owning real estate, nobody's going to come to you and say, hey, the bank went bad, give me your property back. So it's a good, nice, safe place to put your money.
Okay, that's good. So listen, this is March 23rd, and the reason for stating the date is because the Fed raised rates like a quarter point.
Yes, they did.
So when we talk about rates, they're really only effective, we're only saying today, as of today.
Correct.
Because subject to change without prior written notice.
That's correct.
Perfect. So in the paper, there's an article that says, faith in banks has gone down. In 2020, it was 22% had faith in banks, which doesn't seem like a very good number.
True.
Now it's 10%, which is even worse. All right. So talk to me about the Fed rate, right? And explain why that causes issues for banks.
Okay. Well, it's a big topic, so we'll just break it down piece by piece so it's super digestible for anyone who's listening today. The Federal Reserve, when they come out and they say we are raising rates, they are raising the prime lending rate. Prime lending rate is the rate that the bank is going to use as the base interest rate, and then they're going to add their interest rate on top of it to offer you a car loan, a credit card, a house loan, maybe a personal loan. All of those are going to be based on prime lending rate, which as of yesterday is now at 8% before the bank adds their interest rate and fees on top of it.
So just real quick. So is that when you see prime, like a bank will say prime plus?
Yes, that's exactly
So the
what it
prime is that right now currently that 8%.
Yes.
And the plus is whatever the interest rate the bank wants.
That's right.
Okay.
That's right. So you'd see it maybe on a big banner inside a bank window for a HELOC, a home equity line of credit, prime plus 2 3/4, and then all that little tiny writing on the bottom. That's what they're raising when they raise rates. But there's also another very impactful rate, and it's called the Fed funds rate. The Fed funds rate is the rate that the Federal Reserve charges lending and banking institutions to move money to one another, to loan money, or to basically balance out so that each bank has enough reserves, can meet those reserve requirements. And every time they move money from one bank to the next, the bank receiving the money is charged the Fed funds rate from the Federal Reserve.
Which is approximately, well, as of right now, at this moment, right? What is that?
It's slightly under 5%.
Okay, so the big bank, I'm a small bank or a mid-sized bank, and I need to increase my reserves. So I go to one of the big banks, or I work it through the Fed. They're going to send me over
$2 billion.
$2 billion. I got to pay 5% of the $2 billion. And that goes to the Fed, or does that go back to the big bank that sent me the money?
It goes to the Fed.
What does the big bank get that sent me the money?
It depends on whatever their terms are, but typically it's just a swap to keep the banks going so that everybody is meeting their requirements so that the banking system is whole, which is why when we saw a problem with First Republic about a week and a half ago, a banking consortium came together and all different size banks put money into the deposits of First Republic to help shore them up.
Are you saying the banks played nice?
I actually am saying that. Yeah, they did play nice. But I don't know what the deal was on the backside.
That's the real question. That's the second real question. My money is safe up to a certain point, and then what's the story on the backside? So,
True.
Okay, so now you move, so the big banks move this money over, the receiving bank pays the interest, right? What do they call that number, that interest rate?
The Fed funds rate.
Okay, perfect. So, and that's just used to keep the reserves high enough
Yes.
to protect the money of the depositors and the investors in a bank.
Correct, because each bank is required to meet the stress tests,
Okay.
reserve requirements of 2008. And those stress tests require each bank to have a certain percentage of the money that they have out on loan. They have to have a certain percentage of that in liquidity in their depository as well. So in the case of Silicon Valley Bank, which we know now it's in the history books, they failed. Just a quick revisit of that. Basically what happened with them is that the Wednesday preceding their being taken over by the Fed, they went to their investors and said they needed to raise $2.25 billion, like overnight, which means they had to sell their assets to raise that money. They did do that. And then on Thursday, thanks to panic on Twitter, they had a run on their bank and $42 billion was withdrawn on Thursday.
Oh, holy smokes. Okay, so the stress test thing. Okay, give us some, simplify this. Okay, what does that do? Who does it? And how in the heck did somebody these are smart people.
Yes, they are.
Right. The people running banks, typically really smart people. And how did they get caught? I mean, not that they necessarily did something wrong, but how did they get caught short?
It's such a good question. Well, I'll tell you, there were some analysis errors in the stress test assumptions, actually. And I brought you a document that I thought was relevant. It's from the Wall Street Journal. And basically, it's super important to know that the Federal Reserve has been publicizing now for a year that they are raising rates. They're raising the Fed funds. They're raising prime. It's built in to their assumptions. However, whoever conducted the stress test did not charge or include interest being charged in the Fed funds rate for the reserve requirements for Silicon Valley Bank, which means that they were multi-million dollars in deposits shy because it was charged at near zero. They use a treasury rate of 0%.
Right, but that's not even close. It hasn't been 0% for 3 years?
No, it hasn't. In fact, I brought you another document, Document B. Document B shows that as of 2023, the median Fed funds rate was 2.8%, and then Then again, in 2023, the median projected was publicized at 3.8, both of which are well below what the actual Fed funds rate is. So none of those assumptions would have even been okay. And my question is, how could they have missed that? That's a big oversight
Right.
error.
Right. That's a tough one to swallow. So that goes back to, the question of the day is my money safe? And you've answered that up to $250,000, and you've also talked about ways to, reduce the risk, right?
I have one other thing
Okay.
too. If you have an account, say you have an account that has 500,000 in it, you can designate multiple beneficiaries to spread that distribution out to. So say to Chase Bank, you've got 500,000 in there. I know you have twin boys. You do 250 beneficiary for one son and 250 beneficiary for the other. That 500 would be returned to you.
Okay. So, but also I could take that 500,000 if I didn't like my twin sons, and I could go get another account at another bank,
Yes.
and take 250 out of the one, and then put it in the other. So I have 250 in one account, one bank, and 250 in another.
Correct.
And both of those are covered, right?
Yes. Yes.
Okay.
You of course you love your sons. We should clarify that, right?
That's right. I'd give them $25. No problem. $50, forget it. Okay, so we have this issue with the stress test, and that's really, is that kind of the base of the problem?
Yes and no. It depends. Okay, so there's more problems. So the assets, when we'll go back to Silicon Valley Bank, when they say they need to sell assets, what they're selling is mortgage-backed securities.
Right.
Okay, mortgage-backed securities is, think of like a bundle of loans dumped into a big bucket, a bucket you go buy from Home Depot, and each one of those loans, each one of those pieces of paper you shove in there, all of the loan terms are exactly the same. They're owner-occupied homes, they're single family, their credit scores are 725, they're W-2 employees, they have excellent reserves for emergencies. There's thousands of those in a mortgage-backed security. A bank will buy a mortgage-backed security, and they will sometimes service it, sometimes they'll have a servicer, but they will take in each month the interest on that mortgage-backed security. That's a security.
Okay.
Okay? So Silicon Valley Bank says, well, we need to sell assets, they tell the investors. The investors freak out because $2.25 billion is no small sum. But inherent in the problem is that the mortgage-backed securities that they own are at a 3.5% interest rate ticket. But we started our podcast today talking about the fact that interest rates are at 8% today.
Right.
So you've got a huge disparity between what's coming in and what's going out in terms of fees for the bank. That's part of it. Then in addition to that, they were shy on their deposits. That's another part of it. And then the third thing is they chose to be heavily invested in tech. So they are a bank that's been really focused on tech startups and new ventures and wineries, new ventures. So those are riskier by nature. And with the rates going up, you have a squeeze on other companies. And all of those things come together to create a perfect storm. So when a tech startup goes to Silicon Valley Bank to withdraw money to make their payroll, there's not enough cash in there for that the depositor to pull enough to pay their payroll.
Okay.
So all of those things combined create a perfect storm. Now that could happen to any bank if they weren't prepared.
Okay, so let's go back to the preparation. So I said that these guys are usually pretty smart, these people.
Yes.
It's not guys necessarily, but it's people.
Yes.
Really smart. Do they not know what the stress test is?
They're supposed to know what the stress test is.
But I mean, like, to have these numbers, like, okay, the feds are basing the stress test on these numbers, right, that you talked about. Wouldn't they be able to look at that and go, oh, that's not right?
You would hope so. Yeah, we would hope so.
Okay.
Okay?
But there's no way to prove one way or the other.
Correct.
And it doesn't really matter because all I care about is my money safe.
That's right.
Okay.
So then the Treasury steps in Janet Yellen, who used to be the Federal Reserve Chair, now over in the Treasury, says, okay, that Saturday comes around, she says, we're not helping. That causes a maelstrom. So then the president and the Federal Reserve come together along with FDIC, and they build a plan and they work with the Treasury, and Janet Yellen comes out on Sunday and says, okay, we'll make all the depositors whole, but we're not saving the bank. Anyone who holds shares in the bank and the bank itself and anyone who has a job there, we're not saving you.
Wow.
Because when they balanced their books on Friday before the feds took over, after they'd had that run on the bank the Thursday before, they came out at $956 million in negative deposits.
Oh, boy.
So can this happen to other banks? Yes, it
Okay.
can happen to other banks. But it also depends on what is their business focus, who is their client, what is their lending practices, are they doing a good job passing and honoring the stress test?
What happens to the CEO and the CFO who both sold shares that week?
Yes, they did.
Right.
And they got their bonus on Friday before the Fed seized them.
Of course they did. So,
Yeah.
not that, to people like me, that just frustrates us, right? But most of us don't understand it. It doesn't appear to change. They'll get bail. I mean, back in '08, right, when we finally squared this up, too big to fail. And then the banks that basically drove their own company into the ground were still getting their bonuses.
Right.
So it's,
It's egregious.
yeah, yeah. It's so for the person who's like struggling with their, maybe they have $250,000 in the bank and they're saying, "I just want my money back."
Right.
Right? I'll be happy just to get my money back. Here are people abusing the system
Right.
and getting basically rewarded for it.
Right.
So
And what's interesting is in the history, when these sorts of things are discovered, we have very few people who are actually punished. Martha Stewart, of course, is the one that everybody goes to thinks about and says, oh, well, she got punished. Well, she got punished because her daughter was dating the son's CEO of some major corporation, and she traded based on that information. But
that worked out well for her, though. Now she's best friends with Snoop Dogg. So that's not all so bad.
hey, Snoop Dogg he's got a high IQ, I hear.
Good with the gin and juice.
Yes, he is good with the gin and juice. So do you want to talk about the mortgage cycle?
Yeah, let's tie that in with the bank, all right?
Okay.
Because this is also part of
What's going on?
Yeah.
Yeah. So the mortgage cycle, we talked a little bit about an asset. A bank holds an asset. What we're talking about them holding is a mortgage-backed security. It's a bundle of loans. And that bundle of loans costs a certain amount to buy, and then they service it and they get the interest. They get the cash flow off that investment. It's a cycle. So, Alan, you own a home. When you bought that home, did you get a mortgage?
Yep.
Yep. Okay. And then when rates got really low, you called me again, and did we refinance you?
Yeah, we refinanced, yeah.
We refinanced you. So that is a duration discussion. So from the time you bought your home to the time you refinanced, how long did you have the first loan?
Not that long.
A couple years?
Yeah.
Yeah, so that's a duration.
Okay.
Okay, so the average duration of a mortgage is around 5 to 7 years,
Okay.
somewhere in there. As you know, the unforeseen pandemic caused, 0%
Yep.
treasuries and a ton of refinances. So when the banks went and reinvested in these assets, because all those refinances, that erodes their investment asset, right?
Right.
If you start with a bucket that has 100,000 loans in it, and after the pandemic it only has 12,000 loans left, they need to go out and buy new mortgage-backed securities, right? Okay, so the tickets on those were around 3%, meaning the effective prevailing interest rate on those 100,000 loans in the bucket is 3%. So the client buys a loan at 3%. As the loan originator and mortgage company, we package the loan, we follow the rules, we put all the documents in, checks and balances, dot I's, cross T's, the whole nine. and then the loan moves into the secondary mortgage market, which is where it's sold on Wall Street.
Okay.
Okay, and it's sold as
A mortgage-backed,
a
yeah.
mortgage-backed security. So it may have a servicer. That's a servicer is a company for 30 cents on the dollar will send you your bill every month, will take your payments, will report to the credit bureau companies that Alan Mayseal's late on his payments again. Or
Thank you.
not. Sorry, just kidding.
Let's go with the or not.
Or not. Just kidding. Alan Mayseal's always on time. But that's what a servicer would do.
Okay.
They would report good or bad. And they would take your payments and they would let the investor know that the money has come in on the first of the month. So you'll likely have what's called an aggregator or investor of those loans. So in some cases, it's Fannie Mae or Freddie Mac. So that is the institution that has loans of the money. The servicer could be Doven Mule. It could be Silicon Valley Bank. Who knows?
Right.
Who knows who's servicing it? And then once it's packaged, it's sold on Wall Street, and so on and so on. So it creates like this circle. And every time someone refinances, now you've got 100,000 minus one
Right.
in that bucket. So for refi booms, that's a problem for investors because duration is low.
Right.
So they can't make money on the loan.
Right.
Right.
Okay.
So what they did was they charged a whole lot of discount points for interest rates last year. Did you?
I didn't refi last year, so.
Okay. Well, anyone who went to buy a house or refi, they may have tried to get 3.5%, but during the pandemic, they got it with no points, no
Right.
cost for the rate. But last year, they probably paid 2 points.
To get the rate down.
Yeah,
Right.
yeah. So
Okay.
that is the mortgage cycle, and the duration has to do with how long the person who's borrowed the money keeps the loan.
Okay, so let's hold right there on that, on the duration piece, right? And the cycle, because what I think happens more to people is 1 month they're sending their check to this company, and then the next month it's another company. And that's not necessarily every month. But, you have it for 6 months, and then next thing you know, you're getting a letter saying your loan's been sold to, right? And now you're going to start paying this bank or this servicing company. And so what happens there? Is it literally just like when you gave the example of Silicon Bank, that they just sold the asset?
Yes.
All right, so another company bought it. They put their own servicing company in place.
Yes.
And then when it changes again, it's just they sold it. It was an investment they sold.
Yes.
Or an asset.
Yes. And the other reason why you might get a new servicer has to do with your personal performance on the loan as a borrower. Are you an on-time pay? Are you a slow pay? Are you a late pay? Are you a no pay? That's going to determine where your loan ends up in a bundle, depending on your performance as the borrower.
I didn't know that. That's going to be my next question. What is that? Should I be concerned that my servicer's moving every 6 months?
No. As long as you're paying on time, absolutely nothing to worry about.
Okay.
Yeah.
Okay. So it seems like our banking, I mean, you have all these people, right, that can impact pieces of the banking system. And I think you said at one point that no one person can necessarily create it or solve it, right? No one action.
Right.
Okay. Is it too complicated of a system?
I think that's an excellent question. And the answer is, I don't know if it's too complicated of a system. I think that the system has unknowns about it as we evolve, as social sentiment evolves, as businesses become more sophisticated, as potential new currency enters our markets. All of those variables change the considerations. So the answer is, you can never step in the same river twice. So is it too complicated every time you step in the river? Maybe, but it's really just different.
But it like, the poll we talked about earlier, right? The banks don't have a high rating anyways.
Correct.
And I had no idea it was that low to begin with, and now it's even lower. So, I mean, how many people really understand our system? I mean, you have economists, you have these finance people, and yet things happen that you think, how'd that happen?
You know, Alan, I ask myself that all the time. In fact, I listened really closely, and I follow an advisor. His name's Barry Habib. Thank you, Barry Habib, if you're listening. But I listened to Jerome Powell's comments yesterday and thought, what the heck is he talking about? And Barry Habib was like, he's just wrong today. So even the Federal Reserve chair doesn't always instill confidence when one takes the time to listen to him. So is it too complicated? Maybe it's not too complicated. Maybe it's just that some of the people who are in charge of these processes need to go back to the basics.
Okay. So,
Okay.
but a run on the bank in a pretty affluent area.
Mm-hmm. Oh, are we talking about First
So-
Republic Bank?
Yeah. Okay.
Okay.
Or even Silicon Valley Bank,
Silicon
right?
Valley Bank.
So, that's, you mentioned Twitter. So that sounds like, panic got out in front of reality, but it still got out in front, right? All these smart people, and they couldn't control that.
Nope.
They couldn't even, calm people down a little bit. Like, whoa, hold on, we're going to be okay.
Well, Yellen didn't help at all, but that, right?
Well, there you go. I mean, there are so many pieces that for Joe average, I think it gets back to a real simple thing. Is my money safe?
The answer is your money's only safe if you follow the rules. Listen, here's the answer. In our banking systems in the United States, there is $17 trillion deposited. But only $7 trillion is covered by FDIC. So anyone can do that math. That means there's $10 trillion in the banking systems that is not currently covered by FDIC. Is your money safe? I think it's pretty safe to say there are other investments too where you can diversify and protect yourself, protect your retirement, protect and leave money as a legacy for your children and your children's children. But you got to do it right.
Right.
Yeah.
It's a difficult topic, right? I mean, because it's complicated and it's complex. And so it's not as simple as, hey, just keep your numbers below the 250 in any given bank and you're okay, right? There's way more to it than that.
Yes.
And I think for the average person that just, give me a simple vehicle,
Right.
right, wrong, or indifferent, that may not be the best vehicle overall, but it's the safest,
Right.
right? And so I think that's probably what a lot of people are looking at.
They are. And I put together for our podcast for you to share with our listeners later, I put together an historical look back of the real estate gains from 1944 through 2022. And out of those years, approximately 73 gained. They made money in the form of equity. 7 of them, small losses, and 1, 0. Not up, not down. But if you look at a 77-year history, which could be the remainder of your parents' lifespan and half of their children's lifespan,
Right.
that is financial stability for that family. So if you're at all nervous about having your money in the bank, buy another piece of property. Use it as a down payment. Use it as a hefty down payment and do what people are calling land banking. And that's where you sink your money into land. You own a piece of property and perhaps that property pays you rent. It could pay you 75% of the total cost of carrying that property. And the difference is something then now you've got a write-off on your taxes, depending on how you work with your CPA.
Right.
So there's other ways to play it than just leave your money sitting in a bank where you're really not making any interest on it anyway right now.
You're right.
Yeah.
And now it's a high risk. It's supposed to be the other way around.
That's right.
Give me 10 or 15% and then I got risk.
That's right.
Now you're paying me less than a point and I may not get my money.
Yeah, and The institution is making the money on your money. Never forget that. Don't forget that when you put your money in the bank, the reason the biggest, fanciest buildings on every corner in every city of every state is a bank is because they are the ones making the money. So if you're getting, and I'm talking now about a very boutique-y bank here that's super popular with realtors in Marin, Sonoma, Napa, San Francisco, and its letters are FRB. But if you're working with those banks, it is not uncommon for you to have received a mortgage. Say you got a mortgage for $2 million from them, but they came to you and they said, okay, here's our quote. You can have a $2 million mortgage, but you need to keep $1 million on deposit in our bank for that $2 million loan.
Right. Right.
Now, as a consumer, you feel really good because you're getting beautiful, glossy reports quarterly in your mailbox, but you can't have access to your $1 million. Right. So does that serve you or does that serve the bank? Because the bank then takes 70% of that money and they turn around and lend it out and they make another 3 to 5% or whatever they're charging on it.
Right.
So you as the consumer don't really benefit from having oodles and oodles of cash sitting in the bank.
Okay, let's wrap this up with this. Let's go over it one more time.
Okay.
Not for people who are financially well off, right?
Okay.
Or who are astute.
Mm-hmm.
Okay, this is for just the average person who just wants, just tell me my money's safe. What's your advice to them across the board?
Take a look at your accounts and make sure that you have your accounts. If you have $250,000 or less in each of those accounts in different institutions, you're fine.
Okay.
But if you had 5 accounts at, say, Chase, and each one of them has $200,000, that's not a good gamble.
Okay.
Move your money is the answer. And you know what? There are people in power that are going to just come shoot me for saying it, but that's the truth, and that's actually what's going on right now. People are moving their money around.
Okay. Anything else other than buy real estate, which is always a good piece of advice?
You can buy bonds right now. You're guaranteed to get your money back out of bonds if you buy bonds. The yield on them is better than it has been in the past because the Feds raise rates. So you could make money on that, and it's a secure vehicle. It would have been better if you'd bought them when there weren't any interest being paid on those bonds. But now they're around, 4 to 5%. So they could be good, and it's secure.
Okay. Any other
with respect to
vehicles, so to speak?
Those would be the obvious ones.
Okay.
Yeah. And then with respect, or you could do a REIT, a real estate investment trust. So you could join a group and invest your money, and that group invests in multiple different properties, and they hold multiple different properties. So maybe you don't have a ton of money, but you want to buy into a REIT. That's actually a really good way to invest in real estate and have a small piece of a big investment.
Okay.
Okay.
All right. That was great. Blayney, thanks a lot. We'll be back again with more topics.
Yes, we will.
Yeah, you bet. Look forward to seeing you again. Thank you very
Alan.
much.
Thank you.